Hi, everybody. Welcome back to Dividend Stockpile. So today I'm excited to be joined again by Joe Becker, Director of Product Management with Innovator ETFs, to talk about their brand new income-focused funds, the Innovator Autocallable ETFs, ACII and ACEI. These funds bring a unique twist to the income ETF space, combining structured note features with the accessibility and liquidity of an ETF. So in today's conversation, we're going to dig into how these new autocallable ETFs work, what sets ACII and ACEI apart from the competition, and how they could fit into an investor's portfolio looking for consistent income with defined risk parameters. So Joe, welcome back to the channel.
Thank you, Jeremy. It's good to be here. I appreciate you having me.
Absolutely. I'm really looking forward to talking about these two brand new ETFs you have on board. Last time you were on the channel, we talked about one of your other ETFs, SPUT, and I really love that product. So I'm sure that these products are going to be a hit as well. So high level, if someone didn't catch our last interview, can you talk about yourself and Innovator ETFs and what you guys do?
Yeah, my name is Joe Becker. I am the Director of Product Management here at Innovator ETFs. And I've been with Innovator about 3 years now, a little over 3 years. Prior to that, I worked at Milliman, our sub-advisor, and have been a strategist for many years, also even at Invesco, where I was an income ETF strategist. And so here we are today, also talking about ETFs and income ETFs specifically. Innovator is known for really its buffer ETFs. We launched the world's first buffer ETFs in 2018. Today, here in 2025, we've got more than 100 defined outcome ETFs, over $28 billion in assets. And we see these income products as an extension of that managed outcome ETF lineup. And so really excited to be able to talk about these new auto-callable ETFs with you today.
I think it's going to appeal to a lot of people. So auto-callable is a relatively new concept for retail investors, but I know institutional investors have been doing it for quite some time. So on a very high level, so if people don't know what they are, can you explain what an auto-callable is on a high level?
Sure, yeah. And you're right. A lot of institutional investors or more like high net worth investors have been using auto-callables for a long time. And they have traditionally come in the form of an auto-callable note issued by a bank. And I think an easy way to think about an auto-callable is to think of it like a bond. It is like a bond that pays its coupons so long as the underlying reference asset, whether that's a stock market index or an individual stock, so long as that cooperates, the auto-callable continues to pay its coupon. I think another way that's helpful to think about it, to the extent your viewers are familiar with callable bonds, right? These are similar in that they're callable and have a coupon. And so I think there's more to it than that, but that's a helpful starting framework for thinking about how auto-callables work.
All right, it's very, very interesting. Thank you for that summary. So you had mentioned that there's a certain threshold in interest payment. Can you tell us when the interest payment may not be collected?
Yeah. So that is part of what makes an auto-callable an auto-callable, and part of what gives it that high income that investors have come to love. There is a feature built into this, and it's called, we refer to it as a barrier. And in our ETFs, and we can talk more about it later, but in our ETFs, we have a barrier of 30%, right? And so what that means is, if, again, that underlying reference asset, whether it's a stock market index or an individual stock, if the price of that falls 30% and it is down 30% on the day when we look to pay that coupon, in that instance, the coupon would not be paid on that given month or that given quarter. Now, it's just for that month, though. If the next month that price has gone back up and is now above that 30% barrier, the auto-callable will continue to pay that high rate of income.
Okay. And with that, do you guys have a single instrument that you buy, or is it multiple? Like, what happens if it's that 1 month and the price is down and doesn't pay out, is that the entire interest payment is lost, or is it only a portion of it?
Yep, and that's a very important point here, is that we're holding multiple auto-callables in our ETFs, and so and we're also laddering these out so that it's not that the whole fund misses its income. It's just that we have one auto-callable that happens to be down that month. So we anticipate that if the market is down, and again, and we can talk about stats around this as well. It's pretty rare when a market takes a 30% dip, right? And those are some pretty severe circumstances. But when that happens, we've laddered these out. We're holding multiple auto-callables to try to mitigate that risk of seeing any missed income as the auto-callable works through its life cycle.
Okay, awesome. So with an auto-callable, you say it's a high interest payment to the holders, which is yourself and by byproduct, us as investors in your ETF. What kind of interest or what kind of payment are we looking at on these, just rough estimates?
Yeah, we're looking at, on one of our ETFs, it's an index-based strategy. In that ETF, we have average coupons of 9.8%. So we're looking about, after fees, we expect around 9% is what we're currently looking at. And then in the other equity-focused ETF, we have an average coupon of 14.3%. So we expect probably a 13.5, call it, after our expense ratio.
Okay, no, that's really good income for income investors. So you had mentioned earlier to think of it maybe slightly as a callable bond or very similar to that. So are we talking about just mainly an interest payment, or is there capital appreciation on these? What does that look like?
Yeah, these will be mostly an interest payment. There may be some potential for capital appreciation in the event that the market has been down a little bit, but we really want to position this as the bulk of the return is coming from the income. And so that's what we want investors to kind of look to that more than any potential for capital appreciation.
Okay, that makes sense. And a potential 9 to 13-ish% your return, with a relatively stable payment is a pretty good draw for a lot of people. So I think that's going to fit in. So with that, I mean, this could fit into a lot of different investor portfolio. You mentioned more of a fixed income side of it, but what kind of spots does this fit into an investor portfolio, or which ways can we really think about where this might fit in or replace something we already have right now?
Yeah, and you're right. Fixed income is a big target for this. High yield bonds, especially, is one that we think it's a great complement to that, or potentially even replacing some of that with high yield bonds. If you look at the high yield bond market, you're taking on drawdown risk that's equivalent to equity market risk with high yield bonds. The coupons on high yield bonds, though, are not as high as they are in the auto-callable market. And so for investors who are using high yield bonds to pursue income, we think this is a great complement to that. I might also lump in even senior loans, right? Senior bank loans, that's become a big space. Coupons there also are not as high as they are in the auto-callable market. That also is below investment grade debt. So something to consider adding to that sleeve of an income portfolio. The other place that we see interest is just using it in a derivative income sleeve. So many investors are using covered call funds to generate income. Really, this is something that fits almost, it's like the other side of the coin of a covered call fund, because instead of selling calls above the market, like a covered call fund, the way that these operate, it's really like you're selling a put below the market to generate that income. So we think it's a nice complement to those kinds of strategies. And then we've even had some advisors say, maybe I just use this in my equity sleeve. In the event that the market is down 30% and I'm dealing with that barrier risk, then this ends up looking kind of like an equity portfolio, with the caveat that if I'm holding this and the market doesn't go up, right? If the market's flat or if it's down a little bit, I'm still generating that high rate of income, whether it's the 9% in the index or the 13% on our equity fund, a nice return when markets are flat or even down a little bit.
Yeah, I think to your point, because you guys have that 30% barrier, if the market is down 20%, you're still getting paid.
That's right.
And so you don't have to worry about it until it hits that 30%. Even if it does, if it's only a month or 2 months, it's only a temporary thing until the market comes back. And generally speaking, the market doesn't go down 30% for very long. It's usually, a major event where it goes down that high or that low, I should say. So
That's right. That's right. And we've looked at that.
okay.
And it really is those kinds of moves are isolated to events like the tech bubble or right the financial crisis. Now we have seen some moves where, like around COVID, for example, or even more recently with the tariff issues that we saw in April. That those were quick drawdowns. I don't think it was 30% around the tariffs, but for the most part, when you have extended deep drawdowns, right? Everybody recognizes these are broad economic issues. They are rare. They are rare. It's not to say it can't happen again, but for the most part, these we expect that these will stay above that 30% level and will continue to pay out that monthly income.
Yeah. And one of the things I really like is the fact that you guys have multiple of these in your portfolio and they're laddered. So even if it does go down 30% in 1 month, only a portion of the portfolio is affected. In the very next month, it could go right back up and have full payment again. So having that flexibility with so many different positions definitely helps minimize the impact of a missed interest payment, if you will.
That's right. That's right.
Awesome. All right, so let's dig a little bit further into these. We talked a lot about autocallables, and they seem like a really good feature for a lot of them. But I know you have two different products, and they operate two different ways. So let's dig into those. So the first one is ACII. High level, can you tell me what that one's about?
Yeah, high level, ACII is our index-based fund. And what we're doing there is we have what's called a worst of strategy. And the reason we went with this strategy is that it's very popular within the autocallable note space. This is one that's been around for a long time. And by worst of, what we mean is the worst performing index. So we have three indexes that we're looking at within this product. It's the S&P 500, the NASDAQ 100, and the Russell 2000. So well-known indexes that investors are familiar with. And the way that, the way it works is it's focused on the worst performing of the three. It's the worst performing index that triggers the barrier. It's also the worst performing that triggers the callability. And maybe I'll pause here as well and just talk about the callability. I mentioned callable bonds earlier in the video. With these, the callability is not at the discretion of Innovator, right? We don't get to decide when these get called, like a callable bond, right? If Apple issues a callable bond, it's up to them if they want to call it. Here, the callability is based on the performance of the worst performing index. So with our autocallables, we have a 6-month no call period, right? So out of the gate, nothing can get called for 6 months. At the end of the 6th month, if the worst performing index, let's say it's the S&P 500, if that is above its starting price from when the autocallable was issued, the autocallable gets called away. So the coupon would get paid on that date, the autocallable gets called away, and then a new one will come in and take its place on that same day with a new coupon level. Could be higher, could be lower. It will just depend on what the market is offering on that day. So that's how that one works. We have also an equity strategy that holds the 10 largest stocks in the S&P 500. It holds an autocallable on each one of those stocks. And so every quarter, we'll have 3 or 4 of those autocallables coming up for callability, just like we had in the index product. And again, if say Google, we have a Google auto call in the fund. If Google is above its starting price on that date that it comes up for callability, that will be called away. Coupon will be paid, and another auto call will come in and take its place. So 2 different strategies. One, it's the ACEI, the equity strategy that's paying the higher dividend because you have less diversification there than you have with the indexes. But both offering monthly income, high rates of income. We just wanted to give two different flavors for advisors to kind of choose and manage that risk a little bit differently.
Yeah. So for the index one, you're using the three major indexes, but for the ACEI, which is the equity-based one, you're picking some of the top companies. So looking at it right now, you have things like Apple, Amazon, Berkshire Hathaway, Google, Meta. Obviously, it's subject to change, but those are the types of companies you guys are doing these calls on. So these are obviously very well-known, well-established companies that you're doing these autocallables on. So you still have a lot of stability in those names, but because they're individual equities as opposed to the indices, you get a little bit higher distribution on those. And that's where you can get that 13, 14%.
That's exactly right. And as you said, well-known names. And to the extent that one does get called away, we would go back, look at the S&P 500, which are the top 10 stocks. Maybe, if Google gets called, it probably still is in the top 10, and we would do another autocallable on Google on that same day, and then be off to the races again.
So when one of the autocallables gets called away and you have to get a new one, what kind of term is that new one when you have to redo it? And is it based on the market, what the interest would be on that particular new autocallable?
Yeah, that's an important question. In the equity strategy, all the autocallables that we're using are 3-year autocallables. And so, but we have laddered these out so that they're not all coming up for callability on the same day. And we want to try to mitigate that risk. But yeah, so if something does get called, we would go back, issue another 3-year autocallable. In the index fund, ACII, we are actually using a 2-year, a 3-year, and a 4-year tenor for these. And so the same happens there. If the 2-year gets called, we'll issue another 2-year. If the 4-year gets called, we'll issue another 4-year. And another thing I'll say about that, when we were thinking through the construction of the product, we actually were thinking of doing shorter term tenors. We were looking at doing 1-year tenors on the equity strategy, and we were looking at doing a 1, 2, and 3-year on the index strategy. And as we were talking to advisors about how they think about autocallables, one of the things we heard was that they liked to tilt toward longer tenors. And the reason for that is that it increases the likelihood that the autocallable will be called. The longer you hold it, the more likely you are to have a period where that reference asset is above its starting price. So we like that callability because it keeps you away from that maturity event where if you are below the barrier, you're participating in that price return at maturity, right? But over 3 years, it's very rare that you see a market down more than 30%.
I totally agree that the chances of that happening historically have been so low. I can only think of maybe two times in recent history that it's been down for a prolonged period of time. And the market generally goes up, 7 or 8 years out of 10. So the chances of it being extended down for over 3 years, probably pretty rare. But it could happen. But that's the trade-off. But in the meantime, you're getting these great distributions. A couple more logistic questions I have. But what's the expense ratio on these, and what are the tax implications of the distributions on these?
The expense ratio is 79 basis points, just like the rest of our buffer ETF. For the income, we expect that it will be taxed as ordinary income, just like from a bond. And so we want to be sure that investors know that. We expect that a lot of this will be going into qualified accounts where that's deferred, or if it's a Roth, right, there's no tax on it. So.
Another question I had is, I know there's a couple other competitors out there that are having products similar to this. Autocallables have become very popular. Can you kind of give a summary of maybe how your products differ from some of the competition that's out there right now?
Yeah, as we thought about bringing our products to market and thinking through the build out of these, one thing we wanted to do was issue products that were aligned really with who Innovator is, which is at our core, we are risk managers. We built these ETFs to manage risk, right? That's what a buffer does. And so for these income ETFs, we wanted to do something similar. We wanted to stay in that vein of thinking. And there are, of course, a lot of levers you can pull in this space. And so one of the levers is actually leverage. You can lever up your reference asset in an attempt to get a higher coupon. That's one way to do it. And of course, there's trade-offs. That means more volatility, but you are getting a higher coupon. That's not anything we've done with ours. We wanted to keep it simpler. There's also something else called a decrement that can be used, again, to pursue a higher coupon. The trade-off there is that it does leave your reference asset closer to the barrier, all else equal. And so, again, it's not to say that it's better or worse. It's just who we are at Innovator, being more focused on risk. We've issued products that we think are a little bit simpler and probably at the end of the day a little bit less risky as well. So that's a high-level overview of kind of how we differentiate ours from other products out there.
A lot of great information, Joe. Really appreciate it. It's ACII and ACEI. Where can people find more information about these two products?
You can go to our website. Each fund has its own page, and we have actually tools on these pages where investors can come in and see where each individual reference asset is relative to its starting price, just so the investors can have a sense of how close is this to being called, how close is it to maybe not paying a coupon. We wanted to be transparent about that and let investors have all that information. So it's a great resource for investors in these two ETFs.
That's great. I really love the transparency behind that. It's a huge benefit, so you know exactly what you're doing at any one time. All right, Joe, thank you very much for all the information. Again, for everyone, we're talking about ACII and ACEI from Innovator ETFs. Really appreciate the information, Joe, and hopefully we'll talk to you soon.
Thanks, Jeremy. Really appreciate it.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.